Buckle up because Qualcomm Inc. is making massive moves that could redefine the entire future of your tech portfolio. Investors are buzzing about whether the aggressive shift of Qualcomm into AI and edge computing is the master key to unlocking a major upside for the stock. We are peeling back the layers on how this semiconductor giant is evolving beyond its mobile roots to capture the next wave of global tech dominance.
Looking for a fast-charging, ultra-responsive stylus for your iPad? Meet the 2X Fast Charge Active Stylus Pen, designed for 2018 to 2025 Apple iPads. Take your creativity and productivity to the next level. Click the link in the video description to shop now on Amazon.
Next up, we are diving deep into the engine room of Qualcomm Incorporated and its legendary chip licensing model. You need to understand why these high-margin royalties are the secret weapon protecting the company from market volatility, even when handset sales hit a rough patch. We will show you exactly how this unique dual revenue strategy secures the company against industry downturns while powering the devices of tomorrow. The market has been tough on Qualcomm stock with a sharp drop this year, but is Wall Street ignoring the real story brewing under the surface? We are looking past the noise of the Apple modem transition and the DRAM shortage to see if the growth in automotive and AI edge tech is ready to carry the load. You will get the breakdown on whether this is a dying smartphone business or a hidden giant ready to rebound by the end of the decade. Finally, we are analyzing the latest trading patterns for Qualcomm as shares face fresh pressure, while institutional heavyweights and insiders make their next moves. We are breaking down the implications of their massive $20 billion share buyback plan and what that signal says about their internal confidence in the future. Hit that like button and subscribe with notifications turned on so you never miss another high-stakes market update. Is Qualcomm finally ready to break out of the smartphone bubble? Welcome to the high-stakes world of semiconductor investing, where one company is betting its entire future on moving the brain of AI from the cloud directly into your pocket. If you've been watching Qualcomm, you know the name for its dominance in Android chips. But the real story today isn't about phones. It's about the massive pivot toward edge computing and the AI PC revolution. Imagine a world where your laptop and car aren't just connected, but are actually thinking for themselves, running complex models locally without lagging or privacy concerns. That's the vision Qualcomm is chasing, and it's a strategy that could fundamentally redefine their growth trajectory. Qualcomm's secret weapon isn't just their hardware, it's that rock-solid licensing model. By holding the keys to global wireless standards, they generate a high-margin cash stream that acts like an insurance policy, protecting investors even when the hardware market gets choppy. This is why analysts at major firms like J.P. Morgan and Goldman Sachs are leaning into the overweight camp. They see a company successfully diversifying into automotive digital cockpits and the high-growth AI PC market, challenging incumbents like Intel with the power-efficient Snapdragon X Elite. Now, let's get real about the risks. You're navigating a geopolitical minefield. Between U.S.-China export controls and the ever-present threat of supply chain disruption, this stock isn't for the faint of heart. The big question for you as an investor isn't just whether they can build a great chip, but whether they can win the software war, getting developers to embrace their unique neural processing units. We are watching the transition from a hardware supplier to an AI platform powerhouse. If Qualcomm nails this execution, they're not just a semiconductor stock anymore. They're the backbone of the next era of computing. So, are you buying the AI edge story? Or are the risks of a shifting regulatory landscape keeping you on the sidelines? Smash that subscribe button if you want to stay ahead of the next market-moving headline, and tell me in the comments. Do you think Qualcomm has the muscle to topple the giants in the PC space? Always remember, do your own research, because the market rewards the prepared, not just the lucky. Ever wondered why some tech giants seem to have a bulletproof vest in a market that usually eats growth stocks for breakfast? Today, we're peeling back the layers on Qualcomm, the company that isn't just selling chips, it's basically taxing the mobile revolution. If you've been looking for a way to play the 5G and AI supercycle without losing sleep over the usual boom and bust cycles, you need to understand the Qualcomm model. At its core, Qualcomm is a hybrid beast. They have the QCT segment, which builds the Snapdragon processors you find in high-end Android phones. But the real secret sauce is QTL, their licensing arm. Think of this as the company's defensive moat. While hardware sales can be as volatile as the weather, Qualcomm's licensing business pulls in high-margin royalties from major players like Apple and Samsung, regardless of whether the economy is hot or cold. With gross margins north of 70% in that licensing segment, they've essentially turned the fundamental standards of wireless communication into a recurring revenue ATM. But they aren't resting on their patent laurels. Qualcomm is aggressively pivoting into the automotive and AI sectors. We're talking about software-defined vehicles, the kind that feel more like a supercomputer on wheels. By integrating their tech into everything from BMWs to industrial IoT devices, they are diversifying far beyond the smartphone. This is why major firms like J.P. Morgan and Morgan Stanley remain bullish. They see a company that is using its massive royalty cash flow to fund the next generation of edge computing without drowning in debt. Of course, no stock is without its baggage. You have to keep an eye on regulatory scrutiny and the constant tension of contract renewals with handset giants. Plus, as we move into the AI era, the competition is getting fierce. Just look at how custom silicon is shaking up the laptop market. But for the long-term investor, the structural advantage here is hard to ignore. Qualcomm sits right at the intersection of American semiconductor innovation and global connectivity. So, what's the play? Watch their upcoming earnings for signs of growth in the automotive backlog, and look for updates on how they are monetizing AI at the edge. If you're looking for a portfolio staple that balances tech growth with a consistent dividend and a fortress-like balance sheet, keep Qualcomm on your radar. Before you make your move, do your own deep dive into their recent regulatory filings. Knowledge is your best hedge. And hey, if you found this breakdown helpful, hit that subscribe button and let me know in the comments. Do you think Qualcomm's licensing model is the gold standard for tech, or is the competition finally catching up? Keep your portfolio sharp and stay ahead of the curve. Is Qualcomm a sinking ship or a sleeping giant waiting for its next breakthrough? If you look at the 20% drop in stock price so far in 2026, it is easy to assume the former. We have a perfect storm of bad news. A global DRAM shortage strangling Android production, and more importantly, the painful, slow-motion divorce from Apple as they phase out Qualcomm modems. Analysts are piling on, with a wave of downgrades hitting the ticker and dragging sentiment to a 20-year low. BNP Paribas just slashed their target to $120, citing a bleak outlook for the smartphone sector. But here is the multi-billion-dollar question. Is the market so focused on the rearview mirror that it is missing the car pulling into the driveway? While the bears are busy counting smartphone losses, the underlying numbers paint a different picture. Qualcomm just pulled in a record $12.3 billion in revenue for Q1. Look past the handset noise, and you see automotive revenue climbing 15% and IoT, the backbone of AI laptops and connected devices, ticking up by 9%. No, these segments are not yet large enough to fully fill the Apple-sized hole, but the growth vector is clearly pointing in the right direction. We are looking at a classic semiconductor transition, an exhausting upcycle, a difficult reset, and a fundamental rebuild. The math suggests a flat performance in the near term, followed by a climb toward $58 billion in revenue by 2030. What makes Qualcomm particularly interesting right now is the massive divide among the experts. You have a target price range running from a pessimistic $100 all the way to a bullish $216. This is not a consensus trade. It is a battleground. The bulls argue the market is pricing this like a dying smartphone business, ignoring the explosive potential of their automotive and edge AI tech. Then, there is the licensing business, the quiet engine room of the company. Even if they lose a specific chip design, those royalties keep rolling in, keeping operating margins historically high, well above their 5-year average. Of course, nobody is saying this will be easy. MediaTek is hungry for share, and the heavy hitters like Nvidia and Intel are playing for keeps in the AI and automotive space. Qualcomm has to execute perfectly to win in these new, hyper-competitive arenas. If you use TIKR's valuation model, it paints a picture of a company returning to form, targeting an $187 valuation if they can maintain their margins and scale those new growth pillars. That is a potential 36% upside, but only if you believe the transition story. So what should you do? With earnings dropping on April 29, the clock is ticking for management to prove they can pivot. Don't just watch the headlines. Use the TIKR platform to dig into the actual data. Check out our free valuation model and decide for yourself whether the current dip is a trap or a rare entry point. Are we looking at a business in decline, or is the market about to get a wake-up call? Head over to TIKR, pull up the data, and start your analysis before the next report hits. The best investors don't follow the noise, they build their own thesis. Is Qualcomm a tech titan in transition, or just a stock in trouble? Qualcomm recently saw its shares dip 1.4% to hover around the $135 mark, and with trading volume ticking up by 7%, it's clear the market is feeling a bit jumpy. But look past the daily noise, and you'll see a complex tug-of-war happening on Wall Street. You have analysts ranging from bullish targets of $200 all the way down to a bearish $100. Right now, the consensus sits firmly at a hold. It's the classic investor dilemma. Do you trust the semiconductor powerhouse's legacy, or are you spooked by the shifting sentiment? Let's dive into the fundamentals. Qualcomm is trading well below its 200-day moving average of $156, which typically signals a show-me phase for institutional investors. Yet, looking at the balance sheet, they're holding a solid current ratio of 2.51. They aren't just sitting on their hands, either. They beat earnings expectations last quarter, and with a fresh $20 billion share buyback plan on the table, leadership is clearly signaling they believe the stock is undervalued. When a company is willing to buy back nearly 15% of its own float, that's a massive statement of confidence, despite some insider selling from key executives earlier this year. Now, for the income seekers, there's a silver lining. Qualcomm recently bumped their quarterly dividend to 92 cents, pushing the yield to roughly 2.7%. While that's attractive, keep an eye on that payout ratio. It's sitting at over 73%, meaning they're returning a significant chunk of their earnings to shareholders. So, what's the bottom line? With over 74% of the stock held by institutional investors, the smart money is still very much in the game. But as the mobile and IoT landscape evolves, Qualcomm faces stiff competition to remain the go-to for the Snapdragon platform. If you're looking to add this to your portfolio, remember that tech at this scale is rarely a smooth ride. Are you buying the dip or waiting for a clearer signal from the market? Hit that subscribe button for more deep dives into the stocks moving the needle, and let us know in the comments. Do you think Qualcomm is a buy at this price point?